Well, good morning. It's still morning at 10 to 12. So, ladies and gentlemen, I'm really happy to be here. I'm happy to be here again. And it's great to see you again, Mr. and Mrs. Leber. It's great to work with you, and I'm really happy for the support that you're providing us. So this is our collaboration in those last years was really fantastic. So, a little preliminary remark. So when I'm asked, are you still working in politics? Well, yes, I'm still in the advisory council at the government, and I am counseling the financial minister, whether they want it or not. And so far these, in all history, financial ministers were all just men, and currently this is also the case. So I'm just, and do not expect that the minister will be exactly happy about what I'm going to say. But of course, I will also counsel Lars Klingbeil, and I'm also in the minimum wage commission. And well, let's see what this brings. So I can tell you this is well. German Angst is the topic of today. Well, concerning your preliminary remark, it's hard to say. So German Angst, is it that way that regulation causes German Angst, or is it German Angst that causes all the regulation that we have here? It's hard to say, but it is clearly identifiable. So if we look at the current environment, we are in a massive insecurity right now. So what we see here is the weapon imports that the respective countries get from other countries. Blue are the ones that receive their weapons from Western countries. Red are the ones that receive their weapons from the Russian-Chinese axle. And so if you see these polarizations, here we have, actually we're on the verge of a Cold War 2.0. We have a multilateralism, globalism has gone into the background, and protectionism is on the rise. So this is what we see currently. And so you would expect now that there would be more trade currently also with the Mercosur states, so that the West gets closer together, but this is not the case. So we see what Donald Trump is causing, that this leads to a clash between Western states, or it could lead there. It's too early to say that it does, but when it comes to German Angst, what we can say is that the economic and political insecurity in Germany, so well, this team of authors, they are collecting the data for the economic insecurity by looking at media, classical media and social media. Here in gray we see the US, in orange we see Germany, and in blue the rest of the world. This is the worldwide indicator, and these two are part of it. And if we only go to 2021 here, then we see that this orange line typically is above the blue and above the gray American one. So this insecurity in Germany is measurable via different indicators, like, for example, reports about recessions, about crises, about problems, the problem focus, and this is very clearly visible. And we also see the development since 2021. Here, Germany really skyrockets. We don't have that in the US at all. On a global scale, a little. And this has maybe also been caused by the Ukraine war, but in general, it's the economic insecurity that we measure here. So this is rather the effect of the federal government. This, the arguments that we have seen on a political scale, and what we see currently is what happens due to the American politics. So here we see a rise in the world, in the US, and in Germany. We see that this adds on top of this increased level that we have. So we have new peak values when it comes to political insecurity. This is the situation. And it is called German Angst in the Anglo-Saxon world because the Brits are stronger than the Americans. If the Brits don't understand the phenomenon, really, they use the foreign term. And of course, in the English language provides more than enough terms for fear, but this doesn't have to do anything with fear. This is a sort of irrational fear, and that's why they call it angst. And as it's an irrational German fear, it's German Angst. And yeah, this is the term. And so I can talk about the effects. I can't really provide you with evidence for the reasons. Of course, there are there are studies, and if you ask people whether this is a cultural thing, then there would have to be proof about in the past, but there are no information available what happened before the Second World War and even after the Second World War up to the 60s, and so we do not know about the stance of the Germans at that time. And such an indicator, as I showed you for German Angst, right now, because because data are available and on a digital scale, and they are also assessed by AI. So this can be these kind of studies can also be made for the past. But well, this isn't. Could it be that the Germans have lost 2 world wars? Could it be that they had hyperinflation after the war? That they had to do currency reforms? Does it have to do with the fact that they were concerned strongly by the economic crisis? What is the reason? We don't know. But we see the effects. And the effects are that on the one hand, we see that Germany uses growth chances less than others. We're late when it comes to innovations, if we use them at all. This is the next item that I want to talk about. And second of all, when it comes to the financial markets, we are reluctant. Irrationally reluctant compared to other states. We are not using chances for returns as others do, and yeah, I want to talk about this when talking about pensions. So, and here again, compared to the US, because this is the relevant comparison for us, we can see that within Europe, there are states that are more innovative than Germany, but the main difference manifests towards the USA and also towards Israel or South Korea with a little distance. But if we look at the Western states, it's the US who are a leader in innovation and production. And what you see here, this is the startup activity, which is much stronger in the US than here. And if you look at that, this is round about double the number. And this is on a pro-rata basis. So this is people between 18 and 64 who are starting a business that is younger than 42 months. And so in the US, there are many, many more. The startup possibilities in the US are used way more than in Germany. And we see how that manifests. So this comes from the universities often, and this also has to do with the conditions on the capital market, but the conditions in the capital markets, actually, they are more important in the growth phase of companies than in the startup phase. And so mostly it's the universities that fund those startups, and then only the capital markets comes into play. But it is also a different stance that is taken. And so here we have regulation, for example, that plays a role. When German Angst leads to more regulation, and this is due to the fact that new and so from new ideas and new products are derived in Germany. The stance is always, and also in the rest of Europe, that we say, okay, what could go wrong? And then we start regulating. And so for AI, for example, the EU has an AI Act, and something is regulated that has not yet even really impacted the economy. And in the US, this does not exist. The approach is a different one. The startups come, the technologies come to the market, and then when something goes wrong, then there are laws against this, or on the base of existing law, this is addressed. So only when there are things done wrong, then only legislation is created, and also people are punished much stronger than here. But first of all, it is said, okay, use your chances, and if you're doing well, then there is no punishment for that, because everything is going well. And so this is the international comparison. If we look at the European states, here Germany also is weaker in the European comparison. Startups are more frequent in France than in Germany, and also in the Eastern European states, like in Poland, the startup rates are higher, and also in Greece, we even there we see a higher rate of new startups, and this is also due to the fact that they have very well recovered from their big crisis. And if we look at research and development, here too we see that the US do lots more. So these are the expenses on research and development in terms of GDP. These are investments in different areas. So companies, universities, private and public companies. And here the Americans are better. But this only started in the last couple of years. So the differences that we see here with startups, this is not only based on research and development, and we can also see that in patents. So these patent applications, they are higher in the US, and here we and also compared to that, here the distance is big. And here we can say, okay, well, these findings, particularly in Germany, when it comes to research, Germany is not much worse than the US in that regard. We're using, of course, less money for that than the US, but still a lot. So we're actually managing pretty well to transform money into knowledge. And even if we're looking at indicators for competitivity today, like the IMD in Lausanne produces them, Germany is really losing towards other smaller countries in Europe, Switzerland, Netherlands, the Baltic states. Here we're way behind. And if you're taking what the state does, so what you can describe as infrastructure, Germany has really lost in terms of competitivity. The traffic infrastructure, digitalization, when it comes to scientific infrastructure for research and development, here Germany is still among the top 5. So that shows that here we're actually pretty good. But what we're not really doing well is basically transforming knowledge into money via startups and the like. And here regulation has a strong impact. So if you have a startup, you're coming from the Technical University of Munich in the area of artificial intelligence, what do? You look at the impulses of politics. We have the AI Act. We have the risks are always underlined in Germany in the discussions, that maybe jobs are lost and all that. So we create a new a negative picture for a new technology, and if you ask people then, okay, so and then startups go to the US. And this is still valid, even there is a lot of insecurity with Donald Trump right now. But the chances are just huge over there. And this is exactly the problem that we face. So the chances are big because there's less regulation. The chances are big because when it comes to the labor market, there is a different situation in the US than here. So Germany is moving, demographically speaking, into a different situation. We have an older population. We need to face the fact that the population might even shrink at some point in time. This is different than the US, and we also have to say that the tax system is also different. The US are a little less strict in terms of taxation of earnings than we are here in Germany. And this leads to the fact that in the US, in general, we also have venture capital, which is available to a higher extent. And these are the last few quarters. The differences are enormous. And this is in dollars. And the venture capital volume in the US over different years is much higher. Then after that, you have the UK and then the European Union and then the two big European states.
So that's the next step we have here. The capital market, which is determined by many other things in the United States, is much deeper, and it's available for these activities, for the growth of new companies, but also for the startups. Behind that is an issue to do with the securing of the old age. So I would like to pick that out because the United States has a system which is much more funded. It's much more a funded system. And we find out that in Europe we've got other retirement securing systems that are also much more focusing on funded schemes. So they have different opportunities of return. And this leads to the fact in the end that in these countries, more innovation can be financed. Look at the IPO success in Sweden, for instance. That's a lot to do with the fact that the Swedish, a few years ago, have changed their system towards funded pension schemes. So a few questions about that. The demographics, which is an underlying problem, of course. That's the age structure of the German population in 1950, 22, and projected for the year 2070. Now, I didn't go too much into the future, otherwise you would, too much into the past, because that would have been more of a Christmas tree structure with many young populations and not so many old. But that was after the war. But then when you have got less people at a certain age, they can have less children, of course. And then it goes on until 2017-80. On the right side, in red, you see the old ratio. That's the share of the old share of or proportion of old people older than 64 compared to the population that is still in the age where they can earn money. That is between 14 and 64. Meanwhile, we measure it from 18 till 64 because we've got not many who start working at 14. But in red, you see the rise of this older rate in the next 10 years, and then there will be a consolidation phase, and then it will go up a little bit until 2080. The curve at the top is without immigration. So in the red curve, immigration is assumed to be 200 people net coming into the country per year. So the migration balance is 200,000. With this projection, you have to understand that on average, 700,000 people gross will leave the country every year. So 900,000 will come into the country, gross levels. That's important to see. Why is it 700,000 people who leave? Many of them leave to their country of origins. They have now retired and they want to live in their old home countries then, like in Turkey or in Spain or Italy, because the weather is better there and the living costs are not as expensive maybe as in Germany. This is one movement. There's another movement too. So that's a normal exchange. Germans go to other countries as expats. So there are various reasons for that, and you don't have to see this as a brain drain of the Germans. That's really nonsense. But when you look at the figures themselves, we have to assume that quite a lot of people are coming to us, 900,000 people in gross levels every year until many years now. To actually balance demographics, you would need 1.5 or 1.6 people coming to us every year until 2080. And we've got a population of 83 million people, so that's unrealistic. And there will also be a funding problem in the social insurances in the end, because if you want to resolve all the issues by immigration, the people who would come to this country would have to have the same average productivity as Germans, or they would have to be integrated into the labor market so that they can actually acquire this kind of level of productivity. Clearly, but that doesn't happen. Take the integration of refugees from the Ukraine in Germany. The rate right at the moment is 30%. Those of those who are working in Denmark, it's 80%. And the Danish didn't have to integrate so many refugees. That is a matter of volume, of course, but it's also a matter of how to integrate people. It takes a long time in Germany. And then the German population is very much putting their stake on the system of the statutory pension insurance or retirement insurance. Over time, we had an increase in the retirement age. So the factual retirement age is a little bit lower than the statutory one, so we haven't yet reached the 67 years that we want to have in the end. But that's the development that you will see here. Life expectancy and retirement age that is can be seen here, and it's the factual one as well as the statutory one, and there's a difference between men and women here. So you see the life expectancy, which has increased from 1980 to 2018. Women have a longer life expectancy than men, and you can see here that the statutory retirement age has here increased to 67 years. For 2018, it was just assumed that this would be the statutory pension age or retirement age that we will have by 2027, and actually it increased for men and women, a bit more for women than for men. In terms of men, this is not a big movement, but in terms of women, it is. Now, when you look at Germany here, very strong amount, they put their focus on the state or statutory retirement insurance, and that is very much so in Germany. In other countries like Switzerland, UK, or the Anglo-Saxon countries, there is a higher share of transfers from company pension schemes or from capital returns. And then also there are changes in the entrance age. In Chile, this is very high. In the OECD countries, in the stronger developed countries, there's a variation too, but here the share is usually not going beyond 20% regarding the income from work. So Germany puts its focus on the statutory pension scheme, which is actually unfunded. It's done by allocations. It's when you've got a funded scheme which is with capital coverage, it's not that it's not vulnerable at all, but this can actually get better opportunities of returns because you can actually work or fund in other countries where there's a different population. Now here, this is the way how we do pension schemes in Germany. You see, this is the first pillar is the statutory retirement insurance, and then there are others. I don't want to read that out. We've got various restrictions in the second and the third pillar of what can be done on the capital market, and that's an expression of the concern that we always have in Germany, that at the end, the capital that you use in the second or third pillar that the companies have used for you cannot come back. And for that reasons, we have the restrictions. So a stock share in pension funds is limited to 40% in the second pillar. And usually we use these kind of pension schemes or private pension funds here. And for the third pillar, which is for people who work self-employed or get a special private provisions, Riester and Röhre, we call that, in accordance to the ones who mentioned that, and they need to be readjust its once again, and we have not yet found any better pension provisions with better tax provisions than what we have here. In the end, there was a proposal in the last legislation period which wasn't really adopted, and no one takes it up anymore. So it shouldn't be called Lindner pension in the end. That would be fatal. So let's rather wait and take some modifications. But in the end, everyone who was involved in that development, that was employers, the trade unions, the political representatives of various parties, as well as the financial market participants who were part of this consultation process, liked very much this product that was evolving in the end, but it wasn't adopted then. In Sweden, the system is different. Here, the first pillar is much stronger, focusing on capital coverage. So we've got here a contribution and a kind of unfunded scheme, but in addition to that, with a funded scheme, we've got a free type of choice of investments. In the second pillar, the restrictions are not as strict as they are with us in the second pillar, which is the company scheme. So depending on what you invest in, the question in what you invest in is not restricted. You can choose where you invest. We've got some security for retaining the capital and keeping it up, but you can go into into the stock market and buy something there. And on the second pillar, we've got some tax benefits and hardly any regulatory restrictions. So it's a free way of securing your pension when you're in Sweden. And that means that the Swedish capital markets went much more into depth than in Germany because there are many more opportunities. In the Swiss pension system, that's one of my favorite countries really, you've got the first pillar, again, statutory provisions, that is again unfunded, but it covers only a very basic kind of pension. And the biggest thing is the company provisions. There is some restrictions, but not many. There's much more funded schemes, and the question is how to expand that. It's an interesting finding because the Swiss, rather at a late stage in the 90s, expanded their company provisions, pension provisions to the stock market, because before that they used government bonds and corporate bonds, but only after that they had more free development because the returns couldn't be achieved that they needed. So they switched to also stocks and equity funds. And this became effective when the dot-com bubble was bursting. But that wasn't the best time of all, maybe. But after that, it had a very favorable development. And in the private provisions, that's the third pillar, we've got 3A and 3B, where you get various tax benefits, not much restriction, but here you cannot have more than 50% stocks in that provisions. In the United States, the system is quite consistent. If you look at it, the first pillar is not really doing a lot because you don't get much by that. Through company provisions and private provisions, you can actually get to your money. So the capital market gets much deeper because of that. When you look at this and compare the four countries we just looked at, how much pension assets is invested in the capital market, you can see that here for the different countries. Germany, these are the assets in relation to the GDP, and you will see that Switzerland and USA are leading with 170%. Sweden is following with a clear increase from 67 to 109%. And maybe it's better if you actually switch off the light, because then we can see it better. Because Germany is rather at low levels from 6 to 8%. So you can see, thank you. You can see here this very big difference in securing the assets for old age retirements. And this compared to other countries, they have other rules and they have allowed more things for longer periods of time. So that expresses the concern, I would say, that you could have actually misjudgments in your investments and you could lose part of the money. You want to be hedged and secured fully. This idea of being secure, which is maybe probably caused by German Angst, plays a very big role in Germany. You can see that here very clearly. Now, beyond that. I mean, you can also look at other OECD countries and see who is using what and how much weighted is each pillar, and how about the stocks and the capital market in which pillar. And USA and Switzerland are clearly before Sweden and Germany, and there are also differentiations down to Costa Rica. But the picture looks the same. The Germans, with regard to potential risks that they see here, are particularly cautious. Now, for the return of Riester, we looked at this compared to others. Also, with regard to the 401k returns, here 10-year government bond is the least performing one. Riester is a little bit better than 10 years government bonds. And the savings book, actually, which is still a favorite tool of the Germans, is still very low. Still, many people stick with their savings books. That's a kind of irrationality that you don't really understand. Many countries started to work with government funds. I'm showing that for the 4 countries here, and that's the return compared to volatility. So what do they do here? The pillars are the returns of the pension funds of the second and third pillar in the current year, in the respective years, and the line show the standard deviation from that line, return. So for the United States, the standard deviation is a bit higher. If it gets worse, we've got some breakdowns here, but in the course of time, and you could also form an average out of this, that the returns of the United States are much higher. The volatility is higher, but the return is higher as well. That's what we would usually expect as well. There's a positive correlation between the two. Sorry. If you look at the funds, the Norwegian pension fund, they have their specialty with the oil and can use that money. But the Norway pension fund has a high volatility. The annual returns are really have a lot of amplitude, but the correlated return is quite significant. It was higher in the 90s maybe, but it's still high. Now, the Norway pension fund is more and more overrated with political stipulations that you can only invest in certain assets. It depends on the political color of the government, so to speak. This is abused a little bit. When it was totally free, it could achieve higher returns, but it's still quite okay and much more than we saw at Riester, similar German provisions. Now, the returns are also dependent on the asset classes in the Norway pension funds. Look at the financial crisis, quite clear. The stock prices went down, minus 40%, but they would catch up quite quickly here, actually. And in the course of time, the investments in the capital market, stock market, actually had good returns. And of course, it's clearly hedged with fixed income securities, not much of real estate. In some years, there was some real estate included, and now lately, infrastructure for renewable energies is more in the focus. If we summarize all this, the finding of German fear is quite clear. We've got 2 big disadvantages that come with it. On the one hand, regarding the real economy activities, we can see that there's a much lower birth rate in Germany than in other countries when it comes to startups. We have a problem with transferring knowledge into capital. So earn money with the knowledge, go to market with the products. Innovators who are outside the big multinationals, where always innovation is happening, of course, those who are outside this go to market with their ideas will either have to be associated with the existing companies, we know that from the pharmaceutical industry, or they go abroad. That's the trend we can see. And there's this nice thing, Berlin is poor but sexy, we say, and then the Berlin startup scene came, and when you heard what they were saying, everyone said, I hope Google will buy it. Or Bezos will buy it. So the idea that it should be an American investor, that was what everyone wanted. I don't want to talk about the startups in Berlin, of course. You can look that up for yourself, how many value they had in the end. But this is your own estimate, not mine. But that was their attitude, you know, so the trend to rather go abroad. Which means that we have become more lenient regarding investment. We tend to maintain the economic structures we've got with the measures that we take. During the COVID crisis, all our measures were aiming, also in accordance with the provisions from politics, we are aiming at maintaining the structures that were available before COVID. The United States used much more money from a fiscal policy, but they created a replacement for income for companies as well as employees. Still, they were fired as employees. So when the crisis was over and the economy was opening up again, they were looking for another job. Maybe they made a startup, who knows? But in the end, there was a change in the structure because of that. The shock came from the outside. It was buffered in the United States by fiscal policy, but as a next step, this led to a changed structure. We retained the old structure as long as possible, and last year we even expanded the short-term working funds, and we went back to the old rules in order to keep all the old jobs even during a transformation. I don't know why transformation if you only want to keep the old jobs. There's no transformation going on with that.
So this is the situation. And due to that, less innovation. We have different investments, and this leads to the fact that our economic growth is weaker on average than what we have in the US. This is one big disadvantage. The second big disadvantage is that can be seen on the financing side. So we have less capital available in order to finance innovations. That has to do with the fact that we have a big mass of investment that goes into old age funds, and so we are and that we're not using capital-based products here. Thank you very much.